China's central bank is taking another step to boost China's economy. It's cut its reserve ratio requirement by half a percentage point, 50 basis points. What that means is that it's cutting the amount of money that banks need to have or to hold on to. And the aim here is to spur lending, which hopefully spurs growth. Now, for more on China's decision to cut its reserve requirement ratio and how that could impact the economy, let's bring in Anthony Chan, a chief economist at Chase. All right, Anthony, nice to see you as always.
Same here.
As we just said, China has cut its reserve ratio requirement. What does that do?
Well, it's going to increase liquidity. Liquidity was in short supply. The Chinese People's Bank of China was adding liquidity. In fact, this week, you're going to see about 1.1 trillion yuan basically leaving the system of the money they put in, and they have to put it back in. And when they lowered reserve requirements, that in itself adds about 690 billion yuan to the system. So it's going to add more liquidity. It's going to stimulate the economy a little bit more, make a little bit more lending.
So, Anthony, as we know, a reserve ratio requirement is the amount of money that the government says banks need to hold, to lock away, to keep safe, so that we don't have financial crisis meltdowns as we had in 2008. And now China has lowered it to 17%. But given that this could further weaken the yuan and that it could put China in a bigger debt situation, what does this move signal?
Actually, it's a very encouraging signal because at the beginning of the year, the chief economist for the People's Bank of China was saying exactly that message, that they didn't want to lower reserve requirements or ease monetary policy too much because it would lead to increased capital outflows. Now, of course, they're doing exactly that. That tells me that they're feeling more confident that these capital outflows are abating and that it's not such a serious concern. And then on the reserve requirement of 17%, it is still relatively high compared to other countries like the United States. They've got a lot of policy levers to go.
Certainly a lot of room to cut. The United States reserve ratio requirement is 11%, correct me if I'm wrong. But this does still put some pressure on the yuan, and that could lead to more outflows.
Well, if you ask the question, why are we seeing these capital outflows and what's really happening? I think a good part of the capital outflows is a lot of Chinese corporations paying back a lot of that foreign debt. About 15% of Chinese GDP is in the form of foreign debt. And of course, with their foreign exchange reserves in excess of $3 trillion or yuan, they still have a lot of flexibility to continue to support the Chinese currency.
Anthony, just this weekend, the G20 meeting was held in Shanghai, and the People's Bank of China's governor said that China wouldn't deliberately weaken the yuan and that they would work on implementing structural reforms. So what do you make of the timing of this move the day after this meeting?
The timing seems a little bit strange to the financial markets, but to me it signals confidence on the part of the People's Bank of China because it really tells them that we may not see that much of capital outflows and that much weakness. In fact, if you look at the Chinese currency today relative to the basket that they established in the middle of December, that has remained relatively stable. So we have not seen that much weakness in the Chinese currency. So I am not concerned at this juncture. And by the way, what the G20 meeting suggested was, let's put a little bit more emphasis on other tools other than monetary policy, perhaps fiscal policy. So I expect that this year the Chinese will increase the deficit target to something like around 3%, which means it'll give them the opportunity to have that deficit go to as high as 4 or maybe even as high as 5%.
As you said, the idea here is to spur lending and to spur growth, and it will inject around the equivalent of $105 billion into the system. But will this money actually stimulate the economy, and through what channels do you expect this to happen?
I think that it will start to stimulate, to some extent, the manufacturing sector. And I give you some evidence. And the evidence is right after they made that announcement, you saw the mining stocks all over the world starting to go up in value.
Right.
That's going to stimulate housing. They've already taken great steps to stimulate housing activity. They've lowered the taxes, they've lowered the minimum down payments. So all that is going to some extent, stimulate the economy, on top of the fact that the economy is already transitioning towards a more service-oriented economy.
Well, you mentioned stimulating the housing market. There could be some new signs of froth in the top-tier cities like Shanghai and Beijing. Is this a concern?
I don't think it's a concern yet because we saw prices were very weak, and now we're starting to see prices starting to pick up in the tier one, to some extent the tier two cities. Three cities are still pretty weak. So I don't think that we're near bubble territory, but a little stimulation is not going to hurt because there was a lot of excess inventory. So if you take that stimulation on a sort of a steady basis, it's not going to lead to imbalances that are of great concern to me.
Well, Anthony, in the next few days, Premier Li Keqiang is expected to announce China's growth target for GDP for the year for 2016. 2015, the target was 7%. It came in at 6.9%. Analysts are forecasting that he's going to shoot for 6.5%. What are your expectations?
I think that's almost a slam dunk. I think that when you heard the Chinese saying that they wanted GDP to double from the prior 5 years to the next 5 years, if you take your calculator out, you can figure out very quickly that it's going to be somewhere in the neighborhood of 6.5%. That, of course, means it gives them the opportunity to have growth in the neighborhood of 6.4 to 6.6% over the next couple of years, which, by the way, by Western standards, it's a pretty good rate.
Still definitely the envy of all developed economies. Is that an attainable goal, though, 6.5%?
I think over the near term it is, but I will tell you that over the next 5-10 years, that number has to continue to come down. It is the second largest economy in the world. It cannot continue to grow at this pace.
No, that kind of growth is just not sustainable long term. Thank you so much, Anthony Chan, Chief Economist at Chase.